Hey, welcome everybody to the third episode of Cigars and Syndication. I'm Robbie Rogers. I'm here with my co-host Junaid Noor, and we're very passionate about real estate and cigars. We hope that you'll grab your favorite smoke and follow along, and hopefully we can teach you everything you need to know about real estate, and maybe learn a little bit about some cigars as well.
Hello, everybody. I'm Junaid Noor. We have a lot of information about real estate investing. If you want to learn more about real estate investing, please visit our website www.albanyparkcapital.com and hit the resources tab. We have a lot of articles, and if you have any questions, feel free to send us a question on the website.
Today, during episode 3, we're going to be smoking the Liga Privada Number 9 by Drew Estates. This is a double Corona. From the start, it's a really good, strong cigar. I get a nice sweet hint of vanilla and a little pepper. It's a really good smoke.
Wow, Robbie, a double Corona. I mean, are you expecting this episode to go on for 2 hours? Because this is a 2 hour smoke.
It might take 2 hours, but we'll get no more than 15 minutes of good footage.
So I get some leather, I get some espresso, and I get a very nice peppery taste. So yeah, this is a very good smoke. It's hard to find, and if you can get a hold of it, absolutely try it out. It's a great smoke.
Today in episode 3, we're going to talk about inflation and how it impacts real estate. And, inflation at its simplest form is just being able to buy less with the same amount of money over a given period of time.
So Robbie, that's the simplest form of inflation, but a lot of it has to do with the availability of things, right? There's a lot less things available, and right now in this day and age, the inflation is really because there's not enough supply, and then there's a lot of demand for the same things, right? We had COVID, everybody was kind of locked up. As soon as they come out, they want to start buying, they want to start traveling, they want to start doing things. They have a lot of money saved up. We have, I think, the largest amount of savings that we've ever had in the history of the U.S. We have that right now. And so consumers are coming out and they want to buy. The only problem is that because of COVID, there were a lot of shutdowns of factories, and therefore there's a lot of limited supply of a lot of different things, which, if you want something and you're willing to pay $10,000 for it, and I'm willing to pay $11,000 for it because I want it more than you, well, prices start going up, and that's, in essence, what inflation is.
So do you think that this inflation is driven more by a demand pull or a cost push? Or is it maybe some of both?
Well, it's a little bit of both. A lot of it also has to do with a lot of printed money. The money supply has increased dramatically over the last few years. And the Fed is trying to do what they do best, which is trying to control inflation by raising interest rates. But they can also try and reduce the money supply. That's another way of controlling interest rates without having to hamper any kind of economic growth.
With inflationary periods, there's a lot of people that think that real estate is a hedge against inflation. Do you agree with that?
Absolutely. Anytime inflation has gone up, hard assets will always increase in value. So real estate is one of those hard assets. And if you look at the stock market right now, from the beginning of this year, the stock market has dropped 24%, but real estate overall has gone up 29%. And this was a report that was put out by Marcus and Millichap recently. I actually wrote an article on it called Inflation in the Economy. And you can look up that article on our website, www.albanyparkcapital.com. Hit the resources button. We have a lot of these articles there. But yeah, Marcus and Millichap came out with this report, and it basically shows the differences between how the losses in the stock market are translating to people making gains in the real estate market.
With regards to the commercial property, whether it be multifamily or retail, a lot of the owners, they use this as an opportunity to push some of their costs through and get their rental rates and lease rates adjusted to reflect some of the rising costs. I mean, I think that's probably a safe bet in this economy.
Right. So, the value of real estate is all based on net operating income. And as people's wages are going increasing and expenses are increasing, rents will definitely go up. So anybody who purchased their asset even a couple of years ago at a good rate, or even at an average rate, will see their rents go up as their expenses go up. And as rents go up higher than expenses going up, net operating income will go up. As net operating income goes up, the value goes up.
And a lot of people use the consumer pricing index to gauge inflation. Do you think that that's a pretty good rule of thumb in this case? Do you think that the consumer price index is a good indicator for inflation this time, or do you think there's more at play?
Well, I think that the CPI is a good indicator of inflation for the consumer portion. But remember, as inflation increases and productivity increases, you still have a you still have growth in the economy. Now, if inflation is increasing but productivity is not going up, then you have what's called stagflation. And if it's going the other way, where productivity is going down and prices are going down, then you're in a deflationary environment. So right now, from the latest reports, even though consumer sentiment is slowing a little bit, manufacturing index is still going up. The manufacturing indexes has increased, and the economy is still growing. So, we may have a recession maybe a few months into the future, but right now there's no indication of a recession. So that means the Fed is going to keep increasing rates.
And really looking at, like, even the unemployment rate is at 3.5%. How does the unemployment rate correlate to inflation? Because it doesn't seem like that the employment rate is following the inflation.
So what happens is that the last report I read, and I think I just read a report last week that said that there are still 4 million unfilled jobs in the United States. So as jobs are getting filled and workers are demanding more money, they have more to spend. As they have more to spend, inflation will keep increasing. Um, One of my friends, I was in Chicago a couple of weeks ago, and I was talking to one of my friends, and he told me that McDonald's in downtown Chicago is paying $22 an hour to flip burgers. $22 an hour for burger flippers, because they advertised at 15, they advertised it at 16, 17, 18, 19. They couldn't find anybody to take that position. When they hit 22, people started applying and were willing to take that job. So now, if a burger flipper is making $22 an hour, McDonald's definitely will have to increase the rates on their burgers that they sell in order to be able to make a profit margin. That's inflation.
I think that this inflationary period at present is a little bit unusual, and maybe not just a textbook picture of inflation, but maybe you could help everybody understand how past inflationary periods impacted the economy and real estate.
Yeah, so let's just date ourselves now, right? So the last time we had any kind of inflation, it was about 6%, and that was back in 1990. So that means anybody who's 32 years old right now has never seen inflation, or they were infants, so they didn't really care about inflation at the time. Over the last 32 years, we haven't had any inflation. Now, before the 90s, back in the 80s, now I remember back in the 80s, inflation was at 14, 15, 16%. And the Fed started raising rates, and it took them a few years to start bringing inflation back down. Um, my parents bought their house in 1991. And I actually remember it was January of 1991, and they paid 9.5% interest on their mortgage with 25% down. And they were happy. They were like, oh my God, we didn't get a 14 or a 12% interest. We got 9.5. Wow, we got a deal. Most of the people coming into the home buying market right now, are not have never seen those kinds of rates, and they're going to be shocked to see these rates where as of last week the mortgage market was at 7% for a conforming Fannie Mae loan.
Historical inflation numbers in the 80s and 90s, and how the Feds handle it with rate increases. Today, this year alone, the stock market's down 24%. The uncertainty in the stock market and where the Feds are going to take the interest rates. How does that impact people today, and how does that impact passive investors in real estate?
So what happens with your dollar is that you start losing purchasing power, right? So in its most simplest terms, a dollar today is worth more than a dollar tomorrow. With inflation being at 8%, if you have $1,000 sitting in your bank account, at the end of the year, it's worth 8% less, right? So how do you hedge against that? How do you at least maintain your purchasing power or increase your purchasing power? Obviously, the stock market's not doing it. Bitcoin's not doing it. Real estate is still doing well. And because real estate overall was up by 26% this year, that means that anybody who invested in, let's say, multifamily, and I think multifamily was up 14%, if you even lost 8% to inflation, you still have enough left over to keep accumulating and growing your wealth. But a lot of people are, just holding on to their cash. Well, holding on to their cash is not going to do you any good because you're not going to be able to buy the same amount of items a year from now.
Well, and I think that's a really good point. In the multifamily markets and in the commercial real estate markets, the Feds can control the interest rates, but they cannot control how the owners pass their costs through to their tenants. And I think that this is going to be a really good opportunity. This inflationary period is going to be a really good opportunity for the owners of these properties to increase their cost simply because the demand is still there. I would think if the demand wasn't there, that this would be a much tougher push. But because the demand is there, that it'll be a really good time for these owners to continue to raise rents and flourish during this inflationary period.
It's interesting you would talk about demand because this actually goes back to 2008 and the housing crisis in 2008. And right after 2008, what happened was that lenders stopped lending. They stopped lending to purchase existing multifamily. And I know because I was in the commercial mortgage market at the time. I was doing commercial mortgages. And there were people who wanted to refinance their existing multifamily. They had great cash flow, but they couldn't refinance it because we couldn't find a lender to do it. Lenders were not doing any new development of multifamily. And it was very limited development of residential single-family homes. Well, fast forward to 2022, the millennials, which are the largest group of individuals after the baby boomers, are now in the housing market, and they're looking for homes. But because lenders stopped lending, and there wasn't that much of the construction wasn't happening as much as we needed it to be, there is a housing shortage in every major city in the United States. And, the impact of the higher interest rates in the mortgage market is going to be that, people who are looking for a $600,000 home might go and look for a $400,000 home now. But they still need a home and they still need a place to live. And if those homes are not available, then they have to rent. They don't have a choice. You still need a place to live.
Well, I really think that helps shed some light on some uncertainty during this economic period. I think it's probably created a little animosities and some stressful situations from an investing standpoint. And I think that, hopefully we help you understand inflation and how it impacts real estate and how it impacts the stock market and other aspects of your investing.
Well, we've reached the end of our segment. We're about halfway done with our cigars, so maybe we should just keep going and, have people listen to a 2-hour segment. But I think people will just get bored, right? It's a lot of economic data and a lot of economic information. So we hope you enjoyed this segment of Cigars and Syndications. We hope you learned something. Feel free to contact us, leave us a message on our website. And just concluding, I'm really enjoying this cigar, and I wish we could go on for another hour, and I can finish this cigar up.
Yeah, this Liga has been an amazing smoke. Every bit of a 2 hour smoke. Um, I would highly recommend, if you've not tried one, you should try it. It's a really good, a full bodied smoke. I would say that it's one of my favorites. It is a really nice cigar, and you should run out and buy one, and maybe you can enjoy it the next with our next episode.
Also, I just want to mention, I would love for people to comment on our episode. If you agree with us, comment. If you disagree with us and you have a different point of view, I'd love to read about it. We're not economists here, but we are out in the market. We are investing. We are buying. We work with investors. And so we're kind of in touch with the passive investing market and the active investing market. But, hey, if you have a different point of view, feel free to comment on it, and we'd love to hear your point of view.
Hope to see you on albanyparkcapital.com. Check out our articles and keep educating yourself, and let's grow together.
And keep smoking cigars.